What's going on, you guys? This is Christian for Hustle and Bustle. Today I bring a topic that quite a lot of people ask me lately, and it's really beyond my imagination that a lot of Americans don't even know. What is their credit score? What affects their credit score? How can they use their credit score? Should they use their credit score? So first, what is a credit score? Credit score is a number lenders use to help them decide how likely is that they will be repaid on time if they give a person a loan or a credit card. Your personal credit score is built on your credit history. Now, there are a few types of credit score. I'm not gonna go in depth, but Vantage Score is what you can check on Credit Karma, or what you can see on Credit Karma, which is a free app, and I highly suggest you download it just to keep an eye on your credit. But that will be your Vantage Score Model 3. Now, FICO is the other credit score that we have. It's Fair Isaac Corporation, which I have called a few times to double check the information I read or some random person tells me. Most of the time, that random person ends up being wrong, and FICO, which is the inventor of that score, ends up being right, which is kind of logical. So your FICO score ranges from 300 to 850. In the article I'm reading from, I'm assuming they mean FICO Model 8 because they don't specify. And I'm reading an article right now that is actually on Experian. So all in all you need to know is there are 9 models of FICO score which are important to you, because no one yet uses Vantage Score to my knowledge. For car loan, for example, what the car company or dealership checks is your FICO Model 8. FICO Model 9 does not take into account medical bills. So as you can see, medical collections have less impact in FICO 9. Third-party collections have no negative impact on your score, and a rental history can be included in FICO Model 9. Now, did you need to care about this? Not really. This is for more advanced players in the game of credit. And with all that said, I want you to know that credit is just a game. You don't need to really use a credit card to have credit score. You need to have one, but not necessarily use one. So if you're very opposed to credit cards, if you're very Dave Ramsey kind of approach to the world around you, that's great. You can still, have a credit card but not use it, but you need credit to pretty much build wealth in America. If you want to do it faster, then spend 8 years of your life trying to do the things that you can do in 3 years. So the credit score you're going to get checked when you apply for a mortgage, which is important because we're going to talk a lot about real estate on this channel and less about cars. It's going to be FICO Model 2, 3, and 5, which are credit scores created in the 80s, but banks still check them. For example, my credit score when it was around 750, Model 8, when they checked for a mortgage, the 2, 3, and 5 models were around 720. So 720 was the average. So it was something around the lines of 716, 720, 722, and they take the middle one. And based on that, they actually loan you an amount, and based on that, they give you the percentage rate. So there are 3 main reporting agencies: TransUnion, Experian, and Equifax. All of them by law need to provide you one free check per year, which is not going to be a hard pull. What is hard pull? Hard pull is when a lender from a dealership or for a mortgage wants to check your credit. They do a hard pull, which means they pull all of the data of your credit with all the dates, all the balances that you have, and so on and so forth. And they go through that. It's a big piece of paper, or actually it's not paper anymore because, we don't live into the Stone Ages. They didn't really have paper in the Stone Ages. But yeah, it's a big file that actually they go through, and that's going to end up as an inquiry on a credit score, which will lower your credit score with 5 to 10 points for about 2 to 4 weeks. Soft pull is when a lot of the companies now, credit card companies, they have monitoring on the credit score, which is good for them. Actually, they're not doing it really for you. So they show just the number of your credit score, but they don't really go in detail like why your score is like that. So the more hard inquiries you actually do, the more your credit score will decrease. One hard credit pull will stay on your record for 25 months, and after that, it's just gonna go away. For example, right now I got 10 that I did 8 in 2019, and this year all of those 8 will disappear, and I have 2 that I did in 2020, and that will disappear in 2022. So obviously, let's go back on track. 300 to 850. Obviously, the more close to 850 you are, the less risk you are seeing from the bank. Imagine you and me have a bank and somebody comes with 500 credit score, what's up? And somebody comes with 800 credit score. So the guy with 800 or the girl, whatever, they're gonna be more credit worthy, or in our eyes, we care about risk, they're gonna be less of a risk. That means they're better with money. Although when you delve into the, how the credit score is actually formed, it doesn't really mean that. It just means that they're playing the game right. So from this picture here, we can see our credit is basically formed by new credit, types of used credit, length of credit history, amounts owed, and payment history. So there are other things that come into play, like derogatory marks, how many accounts you have, and age of credit. And I'm sure there are others, but they're all into this big pie thing there. Now, as you can tell, the huge chunk, 65% of your credit score, is basically determined by your credit card utilization, or in this case, it says here amounts owed, and payment history. Or do you have any late payments, any missed payments? Is your history anything different than 100%? And amounts owed, credit card utilization. The credit score companies really don't like it when you have more than 9% utilization. For example, you got a credit line of $50,000. Now, once you spend more than, $4,500, that goes over that 9% and your score plummets. I've already done it twice. I made a big purchase of about, I think it's like eight grand or something like that. And the credit card utilization went to 15%. From like 750 or 755, it went all the way down to 712, like the moment that shit hit. Maybe I shouldn't say shit on YouTube, I don't know. And now, since I paid it off, it bounced back to 742. I think I just checked it today or something like that. But this is your biggest play. Amounts owed, basically keep as zero as possible your amounts that you need to pay or your credit card balances, and have a good payment history. Don't skip a payment ever. Because once you skip a payment, you never get it to 100%. I think I watched somebody else's video that they said it's going to take you like 24 years or something like that to get it to 99.999. But don't quote me on that. How I started my credit journey is I read all of those things. And the first year, which was late 2015 when I got my green card, I started applying for credit and for credit cards. I actually don't remember being denied for any. I don't know how and why. Did not apply for any fancy cards, so I applied for cards for the sake of applying. So if you don't know where to put your cards, I have this here. I put my cards here. There's some gift cards, credit cards, and all other cards that I don't really use on a daily basis. So now I end up having 11 credit cards, which I don't use majority of them. And that's the point. You don't need to use them. I use one on a daily basis, and I have two others that have quarterly categories that rotate every quarter, and they have 5% cashback. And as we talked in other videos, always make the best financial decision for yourself, whatever works for you. Now, number of accounts really matter. You do not want to close accounts that you have for 5 years, because that's going to shorten your length of account. So I explained about the hard inquiry, I explained about derogatory marks and late payments, which is your payment history. Amounts owed, this is very important. The last two things are very important. They basically make 65% your score, so owe as little as possible. And a big myth that I keep hearing, don't just go over your pay the minimum on your due date and accrue interest on the amount owed. Don't do that. This is stupid. The banks will not see you as a more creditworthy if you pay a little bit of interest. So the less balance you have, so the more close to zero your balance is, the more your credit score is going to go up. Why? Because the credit card utilization is going to be low. In other words, like I said in the beginning of the video, that some things are counterintuitive in the credit score game. Basically, the more you don't use your card, the more credit score increase you get. Because from the bank's perspective, it makes sense. I lend money, or me and you have a bank, and we lend money to somebody. We don't lend money. We give them $10,000 credit line, okay? We lend that to two people. First person utilizes 60%, so he spends $6,000 and pays it on time. Now, he spends $6,000 on the first of the month and pays it on the 20th. Now, credit scores, they pretty much hit every day. On Credit Karma, they update every week. So his score is going to decrease during those 20 days that he didn't pay his balance. And then he pays his balance in full. So for 20 days, his credit score was going down and down and down, little by little. And now on day 20, he paid the balance, so it jumped back up. So instead of doing that, if you don't spend anything on your card, it's just you got $10,000 to use and $0 to pay. So your credit score actually is going to go up during that month. Maybe not by a lot, maybe by 2-3 points, but it will go up. Whether in the first example, it might not go anywhere. It might actually end up being lower than you started with. Let's say you start with 700, just an example, and then your score plummets to, I don't know, 620. Now, when you pay it on the 20th of the month, your score goes back to, let's say, 680. On the 25th goes to 683. On the 30th it goes to 690. Yeah, but you started with 700. Now you're actually down to 690, which is 10 scores. Damn it. Which is 10 points less than what you originally started with. If that was interesting and of any value, please give that video if that was interesting or of any value, please give that video a thumbs up. Subscribe, share, comment. You know what to do basically. But I gotta remind you because you keep forgetting. So next video I'm gonna do will be busting myths about the credit score, because there's like plenty of them that I hear on a daily basis, and it's very funny because I'm like, who told you that? Well, a friend of a friend of a friend. Did you call FICO? No, then call FICO. It's not that hard. But next video we're gonna review them. Thank you very much for watching, guys. I'll see you next time.